Hello, everybody. Welcome to this week's episode of the Weekly Wrap. This week's episode is episode 13. I do apologize for not having any episodes come out the last few days. I was traveling. I've been traveling a lot the past couple weeks, and I'll be gone for a couple days, actually for a wedding, not this week, but next weekend. So after that, I should be on a schedule for a good while, but I just wanted to come out and say that. Also, if you like this type of content, be sure to subscribe here on YouTube and follow us wherever you listen to podcasts. But let's get into today's episode. So with all the uncertainty in the markets right now and really a lot of bearish sentiment, we're starting to get the real fear in the markets that they'll never recover, that they're going 50, 60, 70% down, get all your money out of the markets. Since that sentiment is really starting to creep in, I want to have an episode dedicated to just that kind of eases those fears a little bit, kind of zooms out, looks at the bigger picture, but also acknowledges the issues that are in the market right now, while simultaneously kind of reassuring that the long-term mindset, the investor, being a resilient investor, it really does pay off over the long term, regardless of what's happening right now or all the fear that's in the market. So that's what we'll be talking about today. The best bull markets really are built on the backs of horrible bear markets or downturns. That's where the best bull runs are made. That's where the most amount of wealth is made. That's how you get the best returns. So I just want to start off with this quick table of signs of excessive optimism and pessimism. Obviously, those will usually be correlated with a market top or a market bottom or somewhere around there. And if you look to the right, that's really where we're at right now. There's no IPOs. You don't really see a lot of acquisitions or mergers. There's not a lot of free money or liquidity in the markets. We're seeing lower PDE multiples than we've seen over the last couple years. One thing about number 7, so central banks have eased for 6 to 12 months. We're actually still in a tightening cycle. So we don't really usually see the Fed tightening during a recession. That's one reason why people are so negative. So we aren't seeing the banks actually ease during this difficult time for the economy. We're actually seeing them tighten. So that is one difference. But typically near the bottom, you'll start to see the central banks starting to ease. So I think for this cycle, what really will be an indicator to me that maybe a change of trend is coming is something along the lines of the Fed coming out and saying that they're going to stop raising rates for now, not even that they're going to cut them, but that they're going to stop raising them. That could be an early indicator. Even number 8, recession declared officially. We are in a recession. The economy has experienced back-to-back quarters of real GDP decline. That quite literally means that the economy is receding. I don't really buy into any of the propaganda or anything that the government says. We're not in a recession. We're in a recession. So I don't really stress too much about number 8. You can come to your own conclusions about whether we're in a recession or not. Investors are cautious and out of the market. We're seeing a lot of retail investors especially start selling, not only because of fears that the market's going to keep going down, but because it's a tough time for consumers. It's a tough time for the working class, which is the majority of the people in the United States, and they need money. And when you're not getting that from a job or an income, you have to start selling assets. You don't want to do that, but when it's that or your family doesn't eat, it's not really a choice. So we are seeing that. And JP Morgan, I believe, was the bank that talked about this today, but I saw an article where they said, or another big bank said that they expect retail selling to continue in 2023, not because of sentiment in the market, but because the households just need the money. that's kind of a unsettling thing to think about, but it is true. And obviously right here, the negative and depressed consumer sentiment, we're definitely seeing that in the market today as well. So this picture, it's actually out of date a little bit, but I'm going to show you where we are right now in the market. So this gold line is the S&P 500 from this year, and the black line is from 2008. So when I got this picture, we were up here around 3,900. Now we're actually like down here around 3,600. So we hit the bottom right here, and now we're kind of coming back up. So we didn't actually breach it this much like they did in 2008, and then they came up and kind of coiled at the previous support that had now become a resistance before they started selling off again. What we're seeing right now is the market came back down to the bottom one day, closed below, came back up, and now we're kind of in this like bounce right here. It might coil, it could go straight back down and then coil, it could go up, and then we don't know what's going to happen, but we came back down here and we bounced back up, and now we're sitting like right around here just above these highs. Or excuse me, we came back down here, sold off, and then back. Sorry, I was looking at the black line. But we're just above these lows from June now. Don't get confused with the dates on the bottom. Those are from 2008. So I do want to take a look at previous bear markets. Obviously, when you're in kind of like a trend like this, you want to look back throughout history and see what typically happens during these cycles. So this is every bear market in the history of our market. And what I'm really looking at is the median right here. I don't really like to use the average because I think that takes into account outliers too much. I like to use the median. And I'm looking at length of the bear market. I'm looking at the decline of the bear market. I'm looking at the time from the peak to the trough. And then we can look forward and look at the trough to recovery just for fun. But we can look at the time to recover to previous level too, but I don't really find that as important when I'm doing my analysis. So if we look at the median length of a bear market, usually it's around 18 months, and we're really only 10 months in right now. So this would be a historically short bear market if it were to end right now. Additionally, the decline is usually in the 30s as far as percentages go. We're still in the low to mid 20s on the major indices. The Dow is hovering right around 20. It might actually be below 20 right now after today, but these two numbers suggest to me that there's more to come in this cycle, that maybe we are deep in the bear market, but it's definitely likely, historically speaking, that it's not over yet. As well, if you look to the peak to the trough, so this would be the top of the market to the bottom of the bear market, that typically takes between 14 and 16 months. And again, we're only at 10 months. So this would be a historically short bear market. And with all the factors kind of playing into this bear market right now, I don't want to bet on it being a short bear market. I don't want to be fearful in my investments, but I don't want to get ahead of myself. And historically speaking, there is still a little bit left. And if we look to the trough to recovery, so this would be from the bottom back till it recovers its previous level, it typically takes about a year. So I don't think we're there yet, but I also don't want to scare anybody by pulling this up. I bring this up to kind of balance out everything else I'm going to say today, so we can kind of just have this holistic mindset that there definitely still could be pain to come. But if we look at the bigger picture, we can kind of see the opportunity that lies in the market as well. So let's continue and talk about what stocks do after bear markets and why bear markets are actually good for a long-term investor. I added this line right here at the top. When returns go down, expected returns go up. And that can seem a little bit backwards, but the market returns on average 8 to 10% per year. It's not going to give you 8 to 10% every year. Sometimes it's going to give you 20%. Sometimes it's going to give you negative 15%. Sometimes it'll give you 5%. It's not going to give you that exact number. So what do I mean by when returns go down, expected returns go up? And basically, all that means is if, say, for this year, the market is down, I think the S&P is down around 22% right now. So let's say we finished a year at negative 22%. Well, if the historical average is 8 to 10%, then we can expect the next couple of years to outperform that 8 to 10% by quite a big margin to return to the mean. So when you see big declines like this, your expected returns for the future are actually going up. And if you're able to identify good businesses, if you're able to identify other good assets and purchase them while they're depressed like this, kind of block out the noise and all the news, then your expected return is actually a lot higher than if you were to buy during a bull run or just an average year. And that can be encouraging to someone with a long time horizon. So if we take a look at previous bear markets and we look to see how the market performs after, the only time that the market was actually red after 2 years after the bear market was in 2001. And actually that was a market that went much lower for 2 more years. So it was kind of a continuation of a larger bear market trend. And so you could kind of just even shove that one to the side if you want to. It's still on the list. But typically speaking, markets go up quite heavily. We haven't been quite 2 years from COVID, but we are still above the bottom of that market. We're actually still above the high of that market. We're still above the high before the COVID crash. A lot of people are saying that we could get back to that high. Maybe that'll be the low in this market, but it just goes to say, even that idea, let's say the low of this bear market ends up being the high of the S&P 500 before the COVID crash. Say you bought right before the COVID market collapsed, you would be up right now, and we're less than 2 years later, even after this huge bear market and all of this has taken place. So it just goes to show that if you just buy and hold for the long term and you're buying and hold good companies or good assets, you're going to be okay. And these times are not times to be fearful, but times to accumulate assets that'll make you better off in the long run. I want to take a look at investor opportunity kind of on a chart. So I actually saw this from like a sub account of Sentiment Trader on Twitter. I really like that account. They have some really cool charts. And if we look at the investor opportunity index from the past 5 years, you'll see that it was kind of flat for a couple of years and then declined significantly after COVID. Obviously, there wasn't a lot of expected returns in that market, but now we've kind of bounced back since this bear market has started. And if you actually zoom in for the past 2 years, we're at a 2-year high for investor opportunity. So even though the market looks like it's just causing pain, there actually is opportunity being created, and the only way you can get huge returns is by getting assets at good prices. And unfortunately, when assets are going to good prices, that's when the news and everybody else is telling you not to buy them and that they're just going to go down, and that it's a mistake just to hold cash. But if we were to look, and I should have gotten a chart for today's episode on this, but if you look at the purchasing power of the dollar, which is just cash, it continually just goes down. It's down 99% over any long period of time. It goes down every single year. The Fed's target for inflation is 2%. We're well above that right now. But if they hit their target every year of 2% inflation, then your money's losing its value every single year. And the only way to protect against that and to have your money increase its purchasing power is to buy assets. It's literally the only way that you can do it. and it's scary, but you just have to do it, and you have to trust that the markets will return. If markets don't return or they completely collapse, then you have bigger problems than your stocks going to zero. An event that would cause that would be something that would be more important than the stock market itself. So really, you just have to get assets at good prices and hold them, and you'll be better off in the long term. So I wanted to pull up this chart just to show that time in the market creates wealth. This is the S&P 500 following catastrophic declines. What do I categorize as a catastrophic decline? I categorize that by the S&P 500 or any index being down by at least 25%. So this chart, it'll show the market 1 year, 3 years, 5 years, and 10 years after a catastrophic decline. It goes back to 1950. If you look back at the returns for 5 to 10 years, let's look at 10 years actually, because I like to be someone who advertises a long-term time horizon, and 10 years is a long time. So if you bought stocks in any of these bear markets and waited 10 years, you would return at the lowest 38.3% and at the highest 403%. And in all of these markets, there were people screaming that it was the end of the world, that we should go to cash, that it's not a good time to be an investor, when it was quite literally the best time to be an investor. It's just scary in the moment because you don't know when it's going to end, but you can know that it will end eventually. The average return after 1 year is 21%. The average year on the S&P 500 gives you 8 to 10%. The average after 1 year after a catastrophic decline is 21%. After 3 years, it's 37%. After 5 years, it's 83%. And after 10 years, it's 213%. And after at least 3 years, there's been no market in the red after a catastrophic decline. So if that doesn't show you that time in the market is your best friend, even when prices are falling rapidly and even the macroeconomy seems like it's collapsing, it's going to be okay if you buy and hold good businesses for a long time. You become a part owner of these businesses or a part owner of whatever asset, and when that company increases in value or generates a cash flow, you are the direct beneficiary of that. It's the only way you can make money without actually working. The work is done in the research. The work is done right now as you listen or watch this episode. I'm just trying to help people avoid making the mistake of not acquiring great assets at good prices or selling good assets at bad prices. That's not what I want to see happen. I have the same chart here for the NASDAQ. So it is a little bit different on the NASDAQ. This is a more niche index. However, the averages kind of still speak for themselves. So you can see after the dot-com bubble, after 10 years, we were still down 33% on that index. But the average return for 10 years after a catastrophic decline, which here is defined by 30% or worse, is 403%. So it's actually higher than the S&P 500, even with that huge decline after 2000. It did take a lot longer for the NASDAQ to recover after that decline. And I'm definitely not saying that the S&P 500 couldn't experience something like that, but since that time we're actually up huge, it just took longer. And the average is still 403% return. So, again, this is not a time to panic and sell your stocks. If you want to sell your stocks, you should have done it in 2020 and 2021 when the Fed was easing the economy and prices were inflated and PE multiples were high. And you're going to have to wait. If you still want to sell your stocks, you're going to have to wait until that happens again, because if you sell now, you're making a huge mistake. Losses don't actually materialize until you sell. Same with gains, but it would be a huge mistake, in my opinion, to sell right now. unless it's a horrible business or you're rebalancing your portfolio or your thesis on the business has changed in such a way to where it no longer fits your investment philosophy. I like this chart. The biggest bull markets follow bear markets. Again, just kind of along the lines of that idea that when returns are going down, your expected returns are actually going up. And this kind of overlays every single bear market on the bottom with the negative percentages in the light blue. And on top is the bull market that followed that bear market. So you can see even after a really scary 57% drop in 2007, the bull market following that was up 401%. In 2020, after being down 34%, we were up 113%. In 2000, the market was down 49%. We're up 101%. In 87, the market was down 34%, and then it was up 582%, and I could go on, but you get the point. The biggest bull runs are built on the backs of bears and bear markets. You should be thankful for them when they arrive because it gives you a great entry point. And that brings me to this chart, which is just the S&P 500 zoomed out from 1986 to today. If you take a look at all the big scary crashes, there it is in 87. There's another one in the early 90s. Here's the dot-com bubble. Here's the global financial crisis. Here's COVID. And here's where we are now. And if you take a look at all of these situations, you'll see that every single huge scary moment is really just a great opportunity to enter the market. The idea is pretty straightforward. Investing really is not that hard. People like to sit and talk about it all day or write big, long books or make it more confusing than it needs to be, but it's not hard. Buy good assets at good prices and don't sell them. And you'll be better than 99% of the people on the face of the planet. That's all you have to do. An event that would cause this market to go to zero is an event where you wouldn't be thinking about your stocks anyways. So it's simple. I know it's scary right now, but you have to trust in what history tells us, what our society, how it functions, which is off of this market, and your own investment philosophy in regards to what you specifically will invest in. But become an owner, become an investor, hold it for 50 plus years, and you'll thank me in the future. I do want to take a look at this chart again. We've been taking a look at it for a couple of weeks now, but today is actually October 3rd. I'm recording this on October 3rd while the market is open, and we actually did start moving up. Typically, in a regular market, you do see these last 3 months do quite well. You see them do better in midterm election years. The fact that we're in a bear market right now, that we're in the middle of one, and it also is a midterm election year, could affect this. We likely do rally to some extent, whether it's a change of trend or just a bear market rally. We'll have to see, but it is very likely that we get some sort of rally into the end of the year, and we are actually seeing that today. I haven't checked since I started recording, but I do believe the market is up over 3% right now, which is quite significant. And I just want to bring this up to kind of keep your head in a place to know. It's important to know your surroundings, to know what climate you're in, and it is important to know that we are in a midterm election year. So this is the we've been looking at this as well. This is a chart depicting what the market does after going back above the 200-day moving average. That is one of the things I'm looking at to indicate the end of the bear market. It won't happen until the bottom has already been in for quite a while, but it's kind of just like an indicator to let you know that, hey, this is a different trend now. We're in a bull market. That's when you'll know that sell-offs should be continued or should be followed by buying and rallies, as opposed to right now when rallies should be followed by selling. you can see that only a few times where we broke above after being below, that it sold off, and both times it was right before a eventual market bottom. So we're not close to doing that right now, but I like to keep it in the back of everyone's minds because it's one of the things that I'm looking at to indicate the end of this bear market. But let's get into the charts now. I want to take a look at Apple first, like we always do. This is the biggest company in the market, and it has the ability to move the markets quite significantly. We did come back down to this zone here from June. We didn't get back down to the June lows, but we touched this zone and have immediately bought off of it. So there were some buyers here on Apple. Apple's been holding up better than the market. The market actually breached through its lows for a day and then came back. Apple has not even gotten back to its lows yet. So there are a lot of people that like to hate on this company. They like to say that it's too big. There's not a lot of growth left. Well, I disagree with them. I can see where they're coming from, but the reality is that even during a bear market, this company is losing less, and historically it gains more in a bull market than the market does. So nothing from Apple has given me a reason to sell it yet. I'm going to hold it until something changes in my investment thesis for it, but that has not happened yet, regardless of what the market cap is. So this is the S&P 500. We did actually close one day below the low from June. You'll see that happened on Friday. And then today we have been surging back into this zone. So I do actually expect some selling pressure to be here because it took us a couple days to kind of coil and then break below. And the fact that we're coming back right now, it almost feels like we're going to test this spot now as like a resistance because we were testing it as a support and then broke through one day. And I wouldn't be surprised if we broke back through to the bottom. I'll explain this more on the Daily Dose episodes that'll be coming up throughout the week. But if we do come back down and we breach through this low and we start heading lower, like another leg down, I expect this channel line to be the eventual destination for the market. There definitely could be some spots where there's some buying pressure, little reliefs in there on the way down, but I would expect this channel line to get hit once again. And we'll take a look at that in the Daily Dose, but this zone's going to be really important. I would be surprised if it broke back above this zone, but obviously anything can happen in this market. Just for reference, so you know what I was talking about, the 200-day moving average, excuse my voice, is this purple line right here. So that would be an indicator to me when the bull market, or when the bear market rather, has ended, as well as this trend line right here. I want to take a look at the VIX. We took a look at it last week. I think I'm going to keep it in these episodes for now, because it's something that I'm looking at to indicate a bottom. It's another reason why I don't think we've hit the bottom yet. Typically in a bottom, you see the VIX spike like this. This was in the 2020 crisis, and it got above 80. Typically anywhere between like 50 and 80, honestly, anywhere in there is a good indicator that you're getting close to a bottom. We're not quite there yet. The VIX is high. It's definitely 29 is very high for the VIX. Typically in a normal market, it's between like 10 and 15 or 10 and 20 or 15 and 20. So I guess just 10 and 20, but we're not quite to an area on it yet that would indicate kind of just that complete capitulation and desperation and just ultimate fear that typically comes with a huge market bottom. Not there yet, but I want to keep it in here so everyone is aware, because they might not look at it every day. Next is Bitcoin, and Bitcoin's been the same since we started this channel. It's trading in this range between like 17,000 and 25,000. And we know that 17.5 to 17.7 level right here is the point of no return for Bitcoin, because if it breaks through there, there's nothing stopping it until it gets to like 9 to 12,000 in here. We're kind of like sitting at this level right now. So if we break through it, I'd expect it to get like right here. That's like 12,000 to 9,000. And it doesn't look good. So this trend line I have on it goes from the start of the bear market cycle for Bitcoin, and we're almost there. We're a couple days away from hitting it, and I think that that'll be a big turning point, whether it goes lower or higher for Bitcoin. I think that it's going to have to move when it hits that trend line. It's been trading flat for way too long. But other than that, I just want to say thank you for watching this episode or listening to this episode. It is a scary time to be an investor, but historically speaking, it is one of the best times to be a long-term investor. So keep the faith. Keep buying good assets at good prices. Don't listen to what anybody else says, and you'll be okay. Again, if you like this type of content, please subscribe on YouTube or follow us wherever we listen to podcasts. Thank you again for watching or listening to this episode, and I'll see you all in the next one.